Hello, everyone. Welcome to India Business Insights. Today, we will be discussing India's inclusion in the Global Bond Index. Before diving deep into it, like, share, and subscribe to our channel. And don't forget to press the bell icon so that you stay updated. JP Morgan recently announced India's inclusion in the Global Bond Index, which could get $25 billion in inflows, a much anticipated move that could attract more foreign flows. Before diving into more details, let's talk about the JP Morgan Index suite, which covers a variety of asset classes ranging from emerging markets and developed market bond indices to credit and tradable index strategies. What government bonds are? A government bond or sovereign bond is a form of bond issued by a government to support public spending and is often considered the safest investment option and used to diversify the risk portfolio as being risk-free and to reduce the overall risk exposure of the investment portfolio. Now let's talk about JP Morgan index suites. The JP Morgan Emerging Market Bond Index EMBI, which is a referenced index of its kind, was formed in the early 1990s after the issuance of the first Brady bond. The initiative further led investors towards higher yielding local rates by launching the Government Bond Index Emerging Markers series. It includes developing economy or country that is progressing toward becoming more advanced by rapidly industrializing and adopting free market economies. The EBMI Plus includes dollar-denominated loans and euro bonds, and countries in the EMBI Plus index are selected according to a sovereign credit rating level. The index is weighted based on the market capitalization of government bonds. Other includes the JP Morgan Global Aggregate Bond Index, which is JPM GABI, spanning asset classes from developed to emerging markets, and also extending to multi-currency, investment-grade instrument, and the developed market indices, which track fixed-rate issuances from high-income countries spanning the globe. And lastly, the credit indices, which covers a wide range of instruments, primarily US and European markets, and encompasses fixed-rate high-grade coverage across these two regions. But how could that possibly be a game-changing shift for India's financial landscape? Well, here's how. Let's decode. Getting noticed? Every country wants its large cap stocks to be part of this index because it launches the country and its stocks on a large arena, which in turn boosts investor participation, confidence, and liquidity for the stock and/or the country and makes the bond market more buoyant. Are there any basic criteria? As it mainly focuses on flows and liquidity, factors like the size of the market, the country rating, and ease of access are the main parameters and are primarily driven by their return expectations. Further, the absence of restrictive laws on the movement of capital, availability of forex, and adequate hedging mechanism that enables transparency and secure transactions are preferred. Does India meet the criteria? India, being the second largest bond market within emerging markets, has been on a watch for the past 2 years. India began discussion on including its debt in global indices in 2019, while also talking to Euroclear about clearing and settlement. The country's unwillingness to discriminate between domestic and foreign investors places foreign investors advantageously for the sake of bond inclusion, and still batting for local settlers of its government securities are the two main points of disagreement. But with the removal of foreign investment restrictions on some government securities in 2020, several bonds are now a part of the fully accessible route and do not have foreign investment restrictions. What are the pros? As per the Morgan Stanley report, inclusion in the global market index could see investors pump $30 billion into India's bond market within 10 months. Further, foreign ownership in GSECs may increase to 10% from the current level of 2%. India has been on index watch positive since 2021 for inclusion into the GBI-EM, following the Indian government's introduction of the FAR program in 2020 and substantive market reforms for aiding foreign portfolio investments. JP Morgan said in the statement, India's weight is expected to reach the maximum weight threshold of 10% in the GBI-EM Global Diversified and approximately 8.7% in the GBI-EM Global Index. The inclusion will start on 28 June 2024 and extend over 10 months with 1% increment on its index weighting, as India is expected to reach the maximum weighting of 10%, JP Morgan said. Now let's understand the impact of this announcement. This announcement contributes towards alluring foreign investors due to its geopolitical importance and as the Western world looks for an alternative to China. The first is a massive inflow and FII. Since April, as reported by the National Securities Depository, foreign investors have bought rupees 25,262 crores worth of government debt, and this inclusion would have a notional value of $330 billion. The other is rupee stability. To enable smooth inclusion, RBI announced 5 securities with different maturity without any investment ceilings, structurally lowering the cost of funding and improving liquidity. It is believed that it could further boost PSU Bank's performance. A lower borrowing cost translates to improved profitability of PSUs with increased lending activity, higher interest margins, and a boost to their bottom line. Such a favorable environment could make it to long-term investment proposition. Domestic currency appreciation could reduce the costs of imports and contribute to greater foreign exchange reserves. The incorporation of India into the global bond index has resulted in structural modifications that bolster the ownership base and liquidity of government securities, which is the G-SECs. Since PSU banks frequently own sizable portfolios of these securities, this strengthens their financial position. The currency will inevitably tend to appreciate as it did from 2003 to 2008 when capital inflows into India skyrocketed. As a result, when investors want to purchase Indian government bonds denominated in rupees, demand for rupees will inevitably rise. All things being equal, this could result in a nominal boost for the rupee. That is a difficulty as well as an opportunity, since we also need to ensure that the rupee maintains its competitiveness. In that regard, there exists the possibility of currency appreciation if the index inclusion proceeds and investor demand for Indian government assets increases. With this inclusion, India will be able to achieve its 2030 economic target of $5 trillion. Just the beginning. India is anticipated to soon be added to the index of other financial organizations in addition to JP Morgan's GBI-EM. Indeed, news headlines about India are already being taken into account for the Bloomberg fixed income indices. India is also included in the FTSE Russell Emerging Markets Global Bond Index watch list. It is significant to remember that JP Morgan, FTSE Russell, and Bloomberg Barclays oversee more than $5 trillion in assets collectively. If you found this informative, share it with your market enthusiasts. Do let us know your thoughts in the comments section. Your feedback is important to us. Thanks for watching. We'll see you in the next video.